start recording. All right. So I'm going to start over for the recording for the people who see this. All right. So this week we have several topics to talk about. We're going to talk about the week's price action. There was a gold squeeze last week and it got aborted. A physical gold squeeze was aborted. I will walk you through that. The details can vary from person to person, but I'm 99.9% sure that's what happened. And my dogs are going to start wanting attention as I start talking. How did it happen? We'll get into that. That'll be the mechanics of it. And we'll talk about the week's price action in a different context and open interest points and last week's player action post-mortem. Most of those things we talk about here regularly, but I'm just giving them subtitles today. All right, here we go. And then outlook for next week. Oh, there's people in the waiting room. There we go. There we go. All right, so when they come in, I'm going to say it's over. Hey guys, you're late. We started at 1 today. We're almost done.
Oh, wow.
No, I'm fucking with
Man,
you.
I shouldn't have slept in.
I'm fucking with you. All right.
Yeah.
All right. So we have some really, I think, really good, interesting stuff to talk about today. And I'm going to be tight on a schedule. You can snicker about that. But I actually have subtopics today. Most of these things you guys know about. The week's price action. The week's price action again from a different point of view. Last week's player action post. These are all, I'm just giving titles to things we talk about. But what's different this week is we just say I'm not hedging myself here at all. The gold market had a short squeeze on the physical side last week. Okay. And it was aborted, but it happened. I'm going to walk through the evidence and why, and I'll tell you how I personally was witness to these sort of things in the past and the mechanics of it. There are plenty of opinions on the mechanics of what happened out there, and I voice some things too. But this is it. It's all over. This is what happened. And well, there may be some variations of what I'm saying, but I'm telling you, there are some things that are just inarguable. All right, so here we go. Plus, there'll be questions as well. Yes. First of all, I'm going to start it out by saying thank you, Randy. I have a couple charts of yours here today. One of them I made heavy use of to show a progression of the week's behavior. All right, so let's get going. That's Randy Blava, R. Blava. Those of you that are relatively new here, welcome, by the way. I know we have a lot of new people. We do this on a weekly basis. If you're not familiar, you're trying to figure out when we do it every Sunday at 2 p.m., unless I say we're not going to do it. Maybe I'll change the time to 3 p.m. Maybe I'll say I'm not doing it this week. But generally speaking, the basis of it is to talk about a concept that we may or may not have interest in. If you don't have interest in it, and I do, then I guess you just suffer. But the basis of it is every week we at least touch on the CFTC Commitment to Trader Report and discuss it in anticipation of the next week's price action. Now, I will say that in the past, until say maybe 6 months ago to a year ago, the CFTC conversation was extremely reliable in predicting the next week's action. And that's because there really was only one or two players, meaning it was the banks versus the funds. And everyone else was small potatoes or not really interested. But as gold becomes more interesting and more players come on the market, into the market, I should say, the strength of the banks have gotten diluted as they've lost money, and the funds have gotten stronger, and they have other players that are assisting them. Okay, so here's the days in question. All right, that's Randy's chart on the right, all marked up by me. Hey, no. All right, so here we go. The red rectangle, 5 days. We have an unchanged day, an up day, an up day, an up day, and then a red doji style shooting star type of candle, right? There's your 5 days here. Here's your 5 days here. All right. The first day, unchanged, doji, half of a spinning top. I used to call it a spinning top. Down 3,300 contracts. I want to use this. 3,300 contracts. The next day is essentially a trend day higher. These terms are important to me. Up 4,500 contracts. The third day, up 62,187 contracts. The fourth day, down 69,000 contracts. And the fifth day, down 7,000 contracts. Okay, we're going to make that make sense. And that's part of the discussion. This part here, that's part of the discussion surrounding the short squeeze that I'm about to get into. The last 3 days are equally important, even though they're not in the report. We'll touch on those. And those days are an up day where open interest comes in, a down day with a long wick below, open interest comes in, and then another down day engulfing that long wick, open interest comes in. So let's start with the last 3 days. The last 3 days are normal fund behavior. Actually, no, it's not normal fund behavior. Well, yeah, it is. These are short funds covering, could be banks, probably funds, right? These are funds getting out and someone catching the knife the first time down, and these are funds just getting out on the third time. Okay, we're done with the pen now. All right, now I'll try and leave this up. I'm letting 2 more people in. Hey, Britt. Hi, Steve. It's all being recorded. All right, so here we go. There's the chart up there. I'm going to go through the days, and the reason I'm going through the days this way, if you're not familiar, is we're going to go through the days describing the open interest as a precursor into describing who's doing what. So day 1, the market is unchanged, and it's a doji. Essentially, you have open interest down 3,300. So basically, you don't know who's doing what. You don't really care. It's a noise day. Day 2 is a trend day higher, up 4,500. That's normal fund behavior in control. The funds are buying, and you would assume that the banks are selling, backing off. Day 3 and 4, I'm combining day 3 and 4, and that's the up 62,000, down 69,000. That's day 3 and 4 here. Those days are 1 day. For open interest purposes, they're 1 day. Okay? For trading purposes, obviously they're 2 days. But for open interest purposes, they're 1 day. When I tell you what happened on the first day, the first 62,000 up day, you understand why the second day is a reaction to it. Put it this way, it was a successful short squeeze. Even though they didn't take physical delivery, it was a successful short squeeze. All right, so back to the actual numbers. Day 3 and 4 is 1 trend day high. That's these 2 days combined, right? That's these 2 days here. Short covering, day 3 and 4. Day 3 and 4 combined is short covering, shorts got squeezed, and curb trading post-market. Probably never heard me say that before, but we're going to talk about it today. This is it. This is like, this is the definitive explanation of what happened. Okay, and it's right until someone proves it wrong. I don't think I'm wrong, having lived it. Day 5 is a normal variation. That's the word, is variation lower, right? So basically, it's a red candle with a new high, but it closes red, and there's a sort of a little bit of a long wick above, not a big one. Day 6, normal day higher, more short covering, meaning the market goes up and the shorts are covering. Day 7, long fund sell. That's the red candle with more short covering. The reason I say that is because the market dipped and stopped, left a long wick high. That was the day we were dropping 10, 20, 30, big drop, and then back to down 20 on the day. All right. Then the last day is your classic funds puking day. All right. Any questions so far? Leon, we could be headed to Armageddon. We could be, but it won't be because of the tariffs. I'm not correcting you, but I looked at Hartnett's report and he made some sense. He's like, the tariffs alone don't do it. It's the policy mistakes afterwards. Like when we had, everyone's like Smoot-Hawley. The press is very left-oriented. And what's that guy's name? Saravelos, the Deutsche Bank guy, who gave a very nice explanation of the dollar risk. That if the dollar drops while the bonds are dropping, it's really bad. And I said that's very real, very small, and very dangerous if it happens. Well, Hartnett came out and said the same thing. He said, this is not 1931, it's 2025. We're not going to make those mistakes again. It's not going to happen again. And then he went on to say, tariffs aren't the whole problem. Tariffs don't cause these problems. The reactions to the tariffs do. So the reason I'm bringing that up is because the legacy media, they latched onto this little report. I mean, I made a big thing of it because it's on my radar now. But they were like, the dollar's going to zero. He's ruining us. I'm like, you have no fucking idea what you're talking about. Anyway, so moving on. Yes, I agree with you, Iggy. Are we giving credit to Kramer for calling the high? Yes, we might be giving credit to Kramer, unfortunately. Yeah, I agree, right? Okay, so here we go. So anyone have any questions about this stuff? We do this all the time. So you're not going to pick it all up in the first conversation, but you will understand that what I just did is a precursor to understanding who did what. And understanding who did what on these days is going to give you an idea of who's going to do what. And so does that tell you which way the market's going? Sometimes it gives you very strong indications of the market where it's going, meaning if this happens, we're going to go up. If that happens, we're going to go down. All you have to do is look at the open interest to get it. Iggy, to confirm my understanding of what you said, the short squeeze is over and we've already likely bottomed, or we have to digest technical damage on the reaction to squeeze. Well, I don't know. That's the interpretation part, Iggy. So no, are you pinning tab 4?
Sorry, planning. I dropped vowels. Planning on showing tab 4.
Right, well, I'm wearing these stupid glasses, so I'm like, is that a capital I? I don't have tab 4 open yet, but I will get to. I'll tell you what, we're gonna spend some time on your stuff all together. I don't want to go back and forth, but just I'm gonna bring up your charts and we'll go through the tabs. How's that?
Sure.
Better that way? Because
Yep.
I have a flow here and I want to get through this short squeeze thing because Michael Lynch, very sharp guy, he's explained what he thinks is happening and he's just almost there. He doesn't see the players. He sees everything but the players. And then there's other people, fat finger, that's complete horseshit. It's not that. Anyway. All right, so this is the basis for understanding the behavior, which allows us to determine who's strong and who's weak. Now, I'm going to say it one more time, even though it hasn't happened a lot lately. In the old days, before 6 months ago, the market had two determinants. The funds determined direction, up or down, and the banks determined how far it would go up or down. So the funds would get bullish and they would buy. I'm going to close the chat unless it's for now because I'll start answering too many questions. So the funds would initiate. The initiator of the trade determines direction, and the funds are the initiator. So the funds say, I think it's going up, I'm going to buy it. The banks are the market makers, or the dealing banks, or the swap dealers, or the bullion banks, however you look at it. The bullion banks make markets. And so a fund says, I want to buy it. A bank picks up the phone and says, I'll sell it to you. But they back off. So it's like a dealer, right? I'm buying, you're selling. So I just keep backing off and I try and keep selling at a higher and higher level to get a good dollar cost average. When the long funds puke, the opposite happens. The long funds say, oh shit, I need to sell. They sell and the banks go, I'll buy it a little bit at a time, all the way down to zero. And they, generally speaking, because the market is biased to be short, market structurally, manipulatedly, that's a word, manipulatively, and other things, and plus they had all this producer selling, they would tend to back off a lot more aggressive on the way down because they didn't have any buying. They were the buyers. They didn't have any buying, but on the way up, they had selling, so they had a producer selling, and they'd front run it. But so basically the market maker would sell 1,000 $1 higher and buy 1,000 $10 lower. So they would kind of let it fall out of bed, and they would encourage it and manipulate it to fall out of bed. They did it for decades. But over the last 6 months, this this relationship between the funds determining which direction it goes in. We're buying, it goes up. We're selling, it goes down. And the banks, as market makers, putting a lid on it or a floor in it, how high it goes, how low it goes. That relationship has completely been distorted. Now, and that's because the banks are getting their asses handed to them, and they stopped making markets. They stopped having producer selling. They stopped having natural selling on their book. And so they started backing off more and more. And so instead of selling $1,000 higher, they'd sell $1,010 higher. So that made the funds make more and more money and pile more and more in. And we're no longer dealing with small funds, CTAs, little guys like us. We're dealing with the biggest of the big funds, macro discretionary funds that have money that rivals the bullion bank allocation. They don't have Fed funds access directly, but they do indirectly. Okay. So when that dynamic changed, it became the funds determining direction and magnitude. So the funds would say, I want to buy it, it's going to go up. So the funds would buy it, and the banks would still sell, but not as much. It was actually becoming more and more apparent that at first, the Bank of International Settlements was capping it just to keep a lid on it for a while. And now the Bank of International Settlements is probably way above, and the other funds were selling it. So one fund would buy it, the second fund would buy it, and by the time it got up to a certain level, the first fund was selling it. So the point is, the banks, while they're still market makers, have decreased in size trading as market makers. So they're less likely to sell in a rally, and because they're short, more likely to buy in a drop. So instead of the market rallying $5 and dropping 50, they now buy it down $5 and don't sell it until it's up 50. And they have been noticeably, we've been seeing them cover shorts actively in the market. And we're going to see that again today. Okay, so that's the long form explanation of that. Before we get into the actual players, I want to talk about the short squeeze. All right, so using Randy's chart again, where is that? Let's use this chart. Okay. The red line is the open interest. And notice the red line spikes. That's the up 62,000 contracts. And then next day, it's down 69. I think those are numbers, right, Randy? 63 and 69?
Yes.
Yeah. All right. So you may look at that and say, wow, a lot of people got in. And you could just look at this chart and say, people got in, it went up, people got out. So this area here, right here, is where someone got squoze hard. And it could have been a lot worse. So these 2 days, this up and down day, are what we're going to talk about. Now, I'm consolidating them for our analysis, but for the short squeeze portion, I want to explain what happened. All right, on the first day, nope, that's not the first day. This is the first day. On the first day, on the close, 62,187 contracts were opened. So that's an increase of 62,000 contracts in a rally. So you would say, simply speaking, you'd say it's a lot of things, but it's funds buying. When you look at the open interest, however, 45,000 of those contracts, this markup is from Craig Hemke. Incidentally, so 45,000 of those contracts was in April, and only 16,000 contracts were in June. Forget about May. All right. April was an expiring contract. Now, I'm going to use some terms of art, but I'm going to use them very specifically for what they mean. The Friday before, March 28th, that Friday was first notice day. Now, first notice day is the day where if you're a long, you must declare that you want delivery or not. So on first notice day, let's say you've got a contract of gold and it's worth 320,000, 3.2 million. And you're controlling it on margin in future.